Okay, so we've got some preliminary questions to work on from your handout. And if you would just take about 5 minutes to go through them, then we'll answer them. And then we'll jump into the handout. I apologize for the delay this morning or afternoon, excuse me, as there was a fire drill for those of you who are watching the video. So this class will be a little shorter than typical class. Give you another minute and then we'll go through them. Okay, so let's go ahead and talk about these. All right, Lamar Printing Company determines that a printing press used in its operation has suffered permanent impairment. So the entry on this would be debit impairment loss. Credit accumulated depreciation. And so this answer is letter B. Of the following costs related to the development of natural resources, which one is not a part of the depletion costs? So we have acquisition costs of the natural resource deposit. So that would be included. Exploration costs would be included in the base. If it doesn't result in finding anything, then they get expensed. But if you find something, then it becomes part of the base. Tangible equipment costs associated with machinery used to extract the natural resource. So this is the answer. It does not become part of the depletion base. It is a separate asset if they plan to use it for more than a year. So it would be depreciated separately as an asset. Usually companies compute depletion for accounting purposes using units of production method. If it said depreciation, I'd say probably straight line for financial reporting purposes. Depletion expense is usually reported as a cost of goods sold when the resource sold. Includes tangible equipment costs in the depletion base. We already know from our previous one that this is not correct. This one is correct, but we have to take a look at the rest of them. Excludes intangible development costs from the depletion base. It's not necessarily, and excludes restoration costs. Restoration costs have to be included in part of it, but it doesn't exclude, so it doesn't exclude those, excuse me. So our answer is A. And then the last one, which one of the following is not a difference between the accounting treatment for depreciation and depletion? Depletion applies to natural resources while depreciation applies to plant and equipment. So that's true. Depletion refers to physical exhaustion or consumption of the asset, while depreciation refers to the wear, tear, and obsolescence of the asset. That one is true. Many methods are available in computing depreciation, but only one is used in any extent in computing depletion. So that's kind of true, but it's not. There are other ways that you can do depletion, as I combine both the words. And so that one is not. The cost of the asset is a starting point from which computation of the amount of the periodic charge is made to operations for depreciation, but the fair value reassessed each year is the starting point for the periodic charge for depletion. And so that answer is correct. E. Any questions on those five? Okay. So let's talk about performing a recoverability test and calculate the impairment for long-term assets. So a recoverability test is the second part of it, or is the first part of the test. So it's the first part of determining whether an asset has become impaired. And so you calculate future cash flows, not discounted, from operations and asset disposal, and compare to the book value of the asset. If the future cash flows, so FCF, from operations and disposal are greater than the carrying value. I think I've got this backwards. Give me 1 second. I have this wrong in my notes, so I want to make sure before I communicate it to you that that is correct. All right, so I did have this backwards in my notes. So here's the notes that we need. My apologies for that. So if the sum of expected future cash flows undiscounted is greater than the carrying value, there is no impairment. If the sum of the expected future cash flows undiscounted is less than the carrying value, then there is an impairment loss. And so for losses, you write the asset down to fair value as the second step. If there is no fair value, use the present value discounted of the, that's redundant, I know, but just to remind you, of future cash flows from operations and disposal. Okay, if you're ready, take a look at example number 1, and I'll walk through it in a second. Okay, so bought a machine in January 1, 2011, and then July 1, 2021, the company reviewed the machine and determined that its future net cash flows totaled $400,000. So we have to determine what is our carrying or book value. And if you remember, that equals the historical cost minus the accumulated depreciation. And so we know that's 800,000, but we don't know the accumulated depreciation. So we have to make that calculation. The accumulated depreciation, it says that we use this, we had a salvage value of 80,000. And so we have to assume here that they're going to use straight line. Unfortunately, it doesn't tell you, and usually they should. So we're going to use straight line. And so we have 800,000 minus the 80,000, excuse me, salvage value. And we're going to divide that by the 20 years of useful life to get our per year depreciation. And so I get 36,000 per year. And so it's been depreciating for 10.5 years. So total depreciation is 10.5 times 36,000. And I get 378,000 accumulated depreciation. So our book value equals 800,000 minus the 378,000, which equals 422,000. So part one, compare future cash flows undiscounted to carrying value. And so we have 400,000 is less than 422,000. So the asset is impaired. Okay, so now we have to take the next step. And so the second step is to compare book value, or sorry, not compare, is to mark book value to fair value. And so we have a $422,000 book value and a 270, make sure I read this right, 280,000, my apologies, 280,000 fair value. So the difference, 142,000, is the impairment loss. And so our answer is E. Any questions? If there are no questions, take a look at example 2. And just see if you can pencil in part A. I'll give you a couple minutes for that. Okay, so the instructions, and I took out some of it, and so it's kind of in the form of a question. For Porto Company, recoverability test compares $4 million expected future net cash flows to 4.9 million book value. And so that 4.9 million comes from the 5,600,000 minus 640,000 of accumulated depreciation. And so that's 4,960,000. So I made that 4.96 million book value. As a result, the asset is impaired because it failed the recoverability test. That's a lot of becauses in one sentence. Expected future net cash flows are less than book value. So a loss on impairment is recorded in 2020. Any questions? B says, prepare the journal entry. So we have to calculate the loss. And so we compare book value, 0.96, to fair value. And our fair value and that number is 2,720,000. And so the difference is a loss. And I have 2,240,000. And so our entry is a debit, the loss on impairment. And a credit to accumulated depreciation, both for the $2.24 million. Any questions there? So now C says, prepare the journal entry for depreciation expense for 2020. So depreciation expense for 2020. So it says, assume Porto will continue to use this asset in the future. The equipment has a remaining useful life of 4 years. So then we take the current book value, which we wrote down, 2.720. And then we divide by 4 years, useful life. And so we have 2,720 divided by 4, and that I have is 680,000 per year. So our entry would be depreciation expense for 680,000 and a credit to accumulated depreciation for 680,000. Okay. And then the last part says for part D, the fair value of the equipment at December 31st, 2021 is 4.1 million. Prepare the journal entry if necessary to record any increase in fair value. And so D here is no entry once an asset is written down to impairment, it is not written back up. And just a little note here, this excludes items that are listed at fair value, which we don't do for property, plant, and equipment. Okay, so now we've got on the next page, just kind of an illustration in case you're more of a visual person. I like this one. Talks about the two-step process. Is it impaired? And then what is done there, just so what we explained. And so if there's no questions, why don't you guys try practice question number 1? Does anybody need another minute on this one? No? Okay. So here, without making some calculations, how many of you think it's impaired? Okay. All right. So our book value equals 700,000. Oh no, sorry, 760. Our expected future cash flows equals 700,000. And so this fails the first test because expected future cash flows are less than book value. So an impairment has occurred. Now for the second step, compare fair value to book value to find the amount of impairment. So we have $760,000 book value and a 560. Did I get that right? $560,000 fair value. So it has a $200,000 impairment. So that answer is any questions? All right. So why don't you try practice number 2? I'll give you about 2 minutes to find the first part and then we'll go from there on it. If you have any questions on anything as I come around, please feel free to ask me. Okay, so it says Dolphin uses straight line depreciation. So that tells us for A, we can take the 6 million cost and divide it by 8 years. No salvage value. And so that should be 750,000 per year times 2 years. And so our book value, 6 million less accumulated depreciation of 1.5 million. Equals 4,500,000. So that's part A. Now try part B. And you guys can talk to each other. This isn't a quiz. If you have questions, don't hesitate to ask me over. Sorry, I'm keeping my phone on after that emergency thing until they send something saying it's clear or not clear. Okay, so let's take a look at part B. So we have our book value. So now we need to do step one, recoverability. And we have future cash flows that we expect for 3,750,000. Our book value is less than future cash flows. So it's impaired. And we want to take and compare the fair value. And the fair value, they said, is 3.3 million. And we're going to adjust the book value, 4.5 million. And so the difference is impairment, and that's 1.2 million. So the entry, loss on impairment, for 1.2 million. And accumulated depreciation for 1.2 million. And then we have C, and I'll give you about 2 minutes. Have a question? Oh, did I do that backwards? Yeah, that's right. Book value is less than future cash flows, so it's impaired. Got it?
Are you saying book value less? Are you saying book value is less than?
I'm saying book value is less than future cash flows. Right, if the future cash flows are lower, then it's impaired. Oh, I should, so book value is more, right? Thank you. Right. Sorry, you're correct. More than future cash flows. So the asset is impaired. Thank you for correcting me on that. No, absolutely. Good question. Okay, so let's take a look at C. So C says, prepare the journal entries for the equipment at December 31st, 2021. So this is the next year after we had the impairment issue. And it says the fair value of the equipment at December 31st, 2021 is estimated to be 3.45 million, which we ignore because we're not going to write it back up, but we do have to record the depreciation expense. So we need to and record new depreciation. Our book value written down equals 3.3 million. Our useful life remaining 4 years. So we divide and we end up with 825,000 depreciation per year. And so we have to record the entry depreciation expense for 825,000 and accumulated depreciation for 825,000. Any questions? Okay, so now we're talking about depletion of natural resources. And it's super complicated. We're going to try to stick to the basics on it. Keep in mind that depletion, some natural resources can be depleted below their historical costs. So you can actually deplete more because we make these strange fair value adjustments with them. So how do we calculate the base that we're going to actually be depleting initially? And so one would be the purchase or acquisition cost. For the natural resources. Number two would be exploration costs for successful. Right? Number three, development costs. Only site-specific prep and assets. Not general use assets that can be moved. And then the cost to return the site to appropriate repair requirements after extraction. So journal entry to create the asset would be a debit to depreciable or depletable asset. And a credit to cash, wages, payable, accounts payable, etc. So this is another one that's very similar to using manufacturing overhead. And what we do with the formula for depletion cost per unit is we take the total costs capitalized minus any salvage value and we divide by the total expected units of production. And then in order to come up with our depletion cost, we have to apply it. And so we use the actual units extracted and we multiply it by the depletion cost per unit. Once the assets are extracted, they get moved to inventory. And so the journal entry would be inventory, extracted asset, and then your credit is to accumulated depletion. And then we have a couple other terms here. And for liquidating dividends, those are dividends greater than accumulated net income. Which we know accumulated net income is equal to retained earnings. Okay, and for dividends in excess of accumulated net income, you would debit retained earnings. So your journal entry would be debit retained earnings. Credit additional paid in capital. For the difference greater than retained earnings or the asset. So now let's look at example 3, and I will walk you through that. I'll give you a minute just sort of to catch up and make sure you have all that. Okay, so it acquires a coal mine. So we have acquisition cost of 1,800,000. You have development costs for 360,000. You have the cost to restore, and that's at the estimated fair value of 180,000. And then you have less salvage value minus 210,000 to give us a total of 2,130,000. And so we have the number of units is 6,000 tons. And so we take the 2,130,000, 2,130,000, and we divide it by 6,000. And that should equal $355 per ton. Any questions there? Okay, example 4, please take a minute to read it and we'll go through it. Okay, so this one's a little bit tricky because it asks what was the amount of depletion that Jaeger should expense. So here we have a depletion amount that's different than the actual expense. So we look at it and say, okay, how much did it cost? And so we're going to create the depletion base. Acquisition. That was 5.1 million. And then it says the property has an estimated value of 300,000 after the ore has been extracted. The company incurred 1.5 million of development costs in preparing the mine for production. So we have development. 1.5 million. And then less salvage value minus 300,000. And it doesn't say any cost to restore the property back into it. So we're going to exclude that now. And so our total depletion base is going to be equal to 6.3 million. We want to get the cost per unit. So we're going to divide by, in this case, 2 million. So we have 6.3 divided by 2, and that ends up with 3.15 per unit. So now 600,000 or 600,000 tons were removed, and those would go to the asset. $480,000 tons were sold. And so we take 480,000 and we multiply by 3.15 to get our cost of goods sold. And so that is 1,512,000. And so you'd have a debit to cost of goods sold $1,512,000. And then a credit to inventory for $1,512,000. Any questions there? All right, now it's your turn. So last few minutes of class here, get to work on that. Oh, dog just got home. Okay, so which one do you calculate? So it says that it discovered the sulfur deposits appraised for 2.7 million more than the value of the land. So that's great, but we don't record the fair value. We record the expenses. And so 480,000 debit to the asset account. So I'm going to start here on 10.12. No, 10:15, right? We're Thursday. I lost a couple days here. 10/15/2024. And if you don't have any questions, you are free to go. I appreciate you. Have a great day. Thank you for being patient, by the way, with the fire drill.